Hello everyone and welcome to our weekly review of our risk model. We start with the general market environment first, looking at the S&P 500 trends over the last few months. Now that's still solidly bullish, strong uptrends. You see the 50-day is above the 150-day and which is above the 200-day moving average, so that looks all good. Same is true for the NASDAQ. So overall, the general market environment is still solidly bullish, which is positive. Looking at the up-down volume next, for the NASDAQ, this is trending upwards over the last couple of weeks, which is a positive. That is true for the NASDAQ as well as for the S&P 500. Now it's not a steep uptrend, but it is an uptrend. So that's also on the positive side. The very important indicator is the new highs, new lows. Now looking at the NASDAQ. So over the last 2 weeks, that changed from being a negative to a positive. So stocks making new highs are more than stocks making new lows. That is a very positive bullish signal for the current market environment. The next indicator we look at is the percentage of stocks trading above the 50-day moving average. Now, this has been a key concern over the last couple of months, and it still is a concern. So we are somewhere between 50-60% here. With this strong of an uptrend, you would like to see the percentage of stocks trading above their 50-day moving average in the range of 70-80%. So that is an indication that despite the strong uptrend, that stock participation in general is not very broad. No? It's thin, and that's why the current market environment needs to be considered as very selective. Last indicator we look at is the advanced decline line. Now that is moving sideways for the better part of the last couple of months with a slow, it might be the start of a new little uptrend here. Now that's a positive. Normally what you see is now that the advanced decline line tops before the general market indices top. So as long as this is solidly trending sideways, there's no reason to get really concerned in this regard. So that looks good. So overall, what we can say, let me open my summary here. Overall, what we can say now, looking at all of these important indicators, the general market environment is still very positive. The problem is that the stock participation, the progress we are seeing for the stocks on our watch lists and in our own portfolio, that is neutral. Despite the strong uptrends, we are not seeing enough traction for the stocks on our watch lists. So breakouts are working in general, but what we see now is that the market is very selective, and we also see sector rotation, which is a theme that is with us for the last couple of months, basically. And that makes it very difficult for traditional swing traders. So now, as recommended earlier, to the best response to this sector rotation here, now, and I add some more comments during the second video over this weekend or today. Now, when we look at our updated watch list in more detail, the only successful way to respond to the sector rotation is to shorten the timeline for our trading. Now this is the thing we can control, is our risk, our stop losses. So what we have done, we have set our average stop loss in the range of 2%, 3%, and we are faster in knocking down profits. So as soon as we have 5%, 6% profits, we nail it down and look for the next best, for the next opportunity. And this is how we have been able to still make progress even in this very selective and difficult market environment. So overall, still positive. I'll add more details in the second video when I talk about the updated watch list. And of course, not today is Monday, it's Labor Day in the US. Markets will open up tomorrow again. So I talk to you in the second video and hope you have a good rest of the week. Hope this was helpful and talk to you next time.